Nirmal Bang, ladies and gentlemen. I'm Hiral Datia. We have with us Mr. V. Ramachandran, Director and Chief Operating Officer at VGuard, joining in. Welcome to the show, Mr. Ramachandran. And always a pleasure to speak to you and get insights from you. Firstly, a spectacular quarter that we've seen as well. The way the recoveries are happening across segments is really great to hear. What's your analysis of the quarter?
Thank you, Hiral. And I think, if I were to summarize, I think quarter one has been a great quarter for us. In fact, if you look at our 3-year CAGR, it's, 3-year CAGR is at about 13%. And, for the quarter, we've had, very, very strong growth, 80% plus. And this despite, the drop in copper prices, which meant that towards the later half of June, I think, wire sales were weaker as generally the trade is destocking. And also, considering that, towards the later half of June, there was a bit of slowness in the market as the weather eased out in many parts of the country. So I think, keeping all this in mind, it is a great quarter. And I think, across product portfolio, we have done well.
Right. So overall, as you also mentioned right now, yes, in terms of revenue growth, good growth that we've seen. In fact, both the southern and the non-southern markets have witnessed good growth. And the contribution of the non-southern markets is also something which is increasing now, which is a good signal as well. Now, coming to the margin front, as you mentioned, commodity prices is something which has continued to put pressure. So how are you seeing that side of it? Though there have been some mild corrections, but I'm sure they're not as per normalized levels right now.
I think the margin picture under the circumstances is healthy. If you look at last quarter, we had to take close to a 10 crore hit, which has had a 1% EBITDA impact, because of the copper prices coming down. But also beyond that, as the commodity prices started to correct towards the end of May and through to June, the price changes that we had to make to recover for input cost increases, right? We could not do so, and that represents some of the shortfall in margin vis-a-vis where vis-a-vis our long-term picture. Having said that, I think the correction in input costs is obviating the need to take further increase in prices. However, the impact of the same can be seen only as we go forward, maybe with a lag of another 2 to 3 months. Yeah.
Right. And by what quantum do we see an increase in terms of prices?
No, I'm saying that we should have seen another 2 to 3% increase in prices coming through, which we have not taken as the input costs have come down. And so I think, as the lower prices flow into our inventory, yeah, I think the margin picture will correct to long-term margins.
Okay. And overall, if you see in terms of where the different segments of business go, if you're talking about electronics, electricals, consumer durables, clearly electronics as a percentage contribution is increasing. Similarly, in terms of consumer durables is also increasing, and electricals is something which is going down. So overall, what's that number that we are looking to stabilize it with in terms of the contribution?
No, I think, structurally, right, I think, our mix is by and large going to remain the same. I think the consumer durable segment is growing faster. And to that extent, the ratio of consumer durable business in the overall business will, go up as in time. Yeah. But otherwise, I think that would structurally, I would say the mix is fundamentally going to remain similar. Yeah.
Okay. And overall, if you see in terms of regions as well, yes, the growth in terms of now non-South is, fabulous. But do you see a stage where we could see equal contribution between South and non-South regions?
Yeah, so we are looking at the non-South business. So non-South is now at about 40 to 43%, and I think in the coming 3 years we look to increase this to 50%. Yeah, so non-South has been performing exceedingly well. Both in terms of business growth, brand equity, and also in terms of the price positioning. So I think we having a pretty healthy and robust business. West, which I mean, we have been pretty strong in East, and our business in North has also been growing over the years. But lately, in the last 2 to 3 years, even our business in the Western region of the country has been growing. So I think overall, we are seeing a very balanced, what I would say, business footprint across the three regions, which is quite healthy. And in fact, West, where we are because of a better power footprint, right, in Western India, typically electronics will be underperforming. But however, the growth in other categories is supporting the overall growth for the region. So I think West was a region that we had some concern till about 2 years back, but even that has now come to similar. So I think by and large, the business footprint of V-Guard in non-South has now become pretty robust.
Right. And overall, if you see from a cash flow perspective as well, the generation at the end of the first quarter has been pretty strong as compared to, and is improved as compared to having a negative cash flow in the first quarter of FY22. So what has led to this kind of growth?
I think if you go back to last year, I think in response to the supply chain disruptions, we had internally taken a call to increase our inventory, right, which resulted in a negative cash flow. Yeah. Of course, I think also relatively Q1 of last year was weaker than traditionally Q1 would be for the company. But that apart, I think generally Q1 and over last year, our inventories had significantly gone up, so that we are able to deal with surprises that may come out of the supply chain side, supply chain what I would say is disruptions. And now as the businesses are becoming more stable and supply chains are also evolving more stably, we are in a position to start to ease our what I would say supplies. We are able to see easing on the supply side, and we are able to reduce our inventory. That being said, we still have more than normal inventory. We are carrying at least another 15 days of additional inventory that we would normally carry, and that represents an opportunity for further cash generation as we go forward.
Okay. And overall, from a utilization perspective, on the capacity front, where are we right now on a blended basis?
I don't have a number, which is, capacity specific for different factories, because the business mix is very different.
Correct.
But I can say that, capacity utilizations are healthy. I think, when you look at our recent manufacturing facilities, which we have set up, which is, fan and water heater. Yeah. So I think water heater capacity utilization this year is going to be to a near capacity, because it's a seasonal business. So the months that matter, for the season, they are going to be, near capacity. And same is the case with fan. The fan factory capacity utilization also has also been progressively going up, and we expect to see seasonal capacity utilization at about 80-85%, because it's a both fan and water heater are seasonal products. So typically 6 to 7 months of capacity is like typically utilized near capacity, and the remaining 4-5 months utilization is lower as the demand tapers off.
Right.
The historical factories like wire or stabilizer, they continue to, what I would say, expand in terms of capacity utilization, as we are seeing, year-on-year growth in the factories.
Right. And any capacity expansion plans?
I think, so we had set up a manufacturing subsidiary, V-Guard Consumer Products Limited, I think, about 9 to 10 months back. And we are setting up manufacturing capacities under we got Consumer Products Limited, and we are coming up with 4 new facilities. Yeah, one for inverter and stabilizer, one for battery, one for TPW fans, and one for kitchen. Yeah, mainly mixer grinders, induction cooktops, and other kitchen products. Yeah, uh, and gas stoves. So I think these 4 facilities are coming up as we speak, and they should be in place over the next 15 months. Yeah.
Okay. And how are we funding these expansions? Is it through internal accruals or will it be a
Yeah, these are
combination of
all.
debt?
No, these are all through internal accruals. We have sufficient cash in the company, and we are generating cash every year, and we are utilizing this cash to generate a better return as opposed to keeping it in the business. Yeah.
Right. And overall, if you have to see in terms of FY23, what is the kind of growth that we are targeting, and what's the next milestone we are looking to cross in the next 2 to 3 years?
I think in general, we avoid giving
I
guidance. Yeah, but I think I can say that we are pretty confident that we will have a strong and positive year for FY23. Yeah?
mm,
We expect the business to grow strongly on the back of growth in all the 3 segments. Yeah, as we are making investments on the manufacturing side to improve our competitiveness. Yeah, and we have been doing this, over the last 2-3 years also. So the significant investments that we've made as a company in manufacturing is going to support our ability to be more competitive and improve our potential for growth and profitability in the coming years.
Absolutely. And it seems as well from the numbers that we are seeing that the company is pretty much on a strong footing as well, which is great to hear. And India as a market itself is on a strong footing right now from a consumption side. And that's going to be the growth story. So hand in hand is what we will see companies like yours play out. Thank you so much, Mr. Ramchandran, for speaking to us, getting us this insights. Again, congratulations and good luck for the coming quarters as well.
Thank you, Hiral. Thank you very much.
Thank you so much.
Nice talking to you. Thank
Same.
you.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.